10. Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in TradFi, digital assets, technology, and financial planning. I'm your host, Jill Malandrino, and joining me on the desk this afternoon in advance of Exchange, an ETF experience taking place in Miami, February 11th through the 14th, we have Matt Barry, Vice President of Product Management and Head of Capital Markets at Touchstone Investments, Noel Archard, Global Head of ETFs at Alliance Bernstein, Ben Slavin, Global Head of ETFs at BNY Mellon, and Ali Doyle, Head of ETF Listings at Nasdaq. They join me to discuss key trends in ETFs, including rapid growth in active and options income ETFs, fund flows, and mutual fund conversions to ETFs. Note that Trade Talks will be live from Exchange February 12th through the 13th, meeting with thought leaders in ETF innovation and asset management. It is great to have everyone back with us. Welcome to Trade Talks. Let's start with a general overview of what fund flows are suggesting for the macro environment in the ETF business. We'll go around the horn. Matt, let's start with you.
Yeah, I think for a number of years we've seen ETFs continue to garner inflows. We're an active mutual fund manager. The mutual fund wrapper has had some headwinds over the years and continual bleeding of assets on that. I think continued inflows into the ETF wrapper. And the ETF rule that the SEC adopted in 2019 really just made it a lot easier for a lot of managers to get into the game. And we've really seen the ETF emerge as a vehicle of choice just due to some of those benefits like the tax efficiency and the trading flexibility.
Right. And Noel, from your perspective?
Yeah, I would agree with that. I think the other hallmark of ETF growth often comes when there are periods of volatility or change in the market, because again, ETFs can be used as both tactical trading vehicles or long-term strategic investments. So we're definitely seeing that dynamic as people are trying to understand, has the Fed really engineered a soft landing? What's going to happen? Are we going to see broadening of growth in the equity markets? Are we going to see some rate pullback? And how do you change your duration in your product set? And so we're seeing a lot of activity in active ETFs, index ETFs, fixed income ETFs, just across the board.
Mm-hmm. Ben?
We also saw record product development last year, and a lot of that product really was actively managed. So over 75% of the products were actively managed of one kind or another. And so we're seeing a more sophisticated type of product come into the market. So it's not just plain vanilla equity anymore. It's a variety of strategies and also new entrants into the market as well, and a trend that we'll continue to see as our pipeline continues to grow with both new product and new issuers coming into the ETF market.
Right, and Ali, your thoughts on fund flows, and if also you can explain how Nasdaq fits within the ETF ecosystem.
Yeah. So just touching on a few things that Ben mentioned in terms of product development and launches, as well as flows. So it was a record $598 billion that went into ETFs in 2023. Almost half of that, about $260 billion, was in the fourth quarter. So definitely a very strong end to the year. In terms of the number of launches, as Ben said, there's been a huge growth within active ETFs. So there were almost 400 active ETFs that launched in 2023. That was 130 more than 2022. So just really continued growth. As Ben said, just new entrants into the market, large global asset managers that are certainly no stranger to asset management but are entering the ETF space for the first time. So that's always exciting to see new entrants into the market. In terms of how Nasdaq kind of fits into the ecosystem, we serve ETF issuers in a few different ways. On the listing side, we see ourselves as an extension of our issuers' teams, working with them in a broad number of capacities, starting with product development, regulatory efforts, launch operational efficiencies, and then really thinking about promotional opportunities and ways that we can support issuers as they think about, marketing their products. Nasdaq also, in some of the other areas of our business, we're also an index provider. So we have an index team that's working with asset managers in licensing the Nasdaq 100 index and other sorts of indices that they're creating. And we also have a developing index options business. So it's been really interesting, again, with the development of new options-based ETFs, the way that Nasdaq is able to work with these managers in a variety of ways.
And perfect segue when you're talking about the growth in active and options income. I mean, we got so used to a market where everything was going from the top left to the bottom right, and then end of 2021, 2022, that composure really shifted. And, Noel, I think that kind of underlies the reason why you're seeing such growth within the active space.
Yeah, absolutely. I think, as Ben said, this is not always what we think of as traditional active. This is a very expensive, it's not your dad's active fund anymore. These are strategies in some cases that I think are can be very thoughtful, can take a risk approach, can use derivative products to try and either achieve income or achieve some type of defensive risk profile for the product set. In the fixed income world, where there's still a lot of inefficiencies, taking that universe and putting it together in a way to try and avoid the bad bonds and buy the good bonds is pretty important, because it's hard to make up if you have bad bonds within a portfolio. So this active dynamic, not only the change in the rule set brought in a lot of new entrants. We're now 4 years out from when 6C11, the ETF rule, came to be, and more active managers launched ETF vehicles. Now we have track records to observe. So the active ETF thing, I'd say it's more than just a pop or a trend. I think this is sort of a systemic shift in the way that ETFs are seen and used. We see active ETFs are about 5-6% of the $8 trillion in the U.S. marketplace, but they're about 25% of the flows last year. Right. So, and as we said, it was the third best year in ETF flows, and just barely missed hitting the 22 mark, which was the second best year. So pretty strong dynamic for the active ETFs on that front.
Yeah, and Noel, I would just add, I think, it's really about the comfort level that advisors are starting to have with actively managed product. I think the option income products are sort of trailing behind, as they're a newer category of product, and there's more varieties coming to market. But it's taken really a few years for not only the advisors to get comfortable, but also just to have wide availability across the various platforms where ETFs are bought and sold, and that's a big change. So if we were having this discussion just a couple of years ago, we would be citing those challenges, and now those barriers seem to be starting to be lifted, and again, you're starting to see the flow happen behind it.
Yeah, every overnight success takes 10 years, right?
Yeah.
To work its way through.
Yeah, I think most of the advisors we work with, the education piece, and in reality, most of them are using ETFs, and they're using mutual funds, and they're using individual equities, so they understand the mechanics. There's some education about how ETF does not necessarily mean passive, and it can be just a wrapper around a different type of strategy. But I think there's a lot of understanding about that now, more so than there would have been 5 or 10 years ago.
I agree, Matt, and I think just, again, the growth of the active ETFs has shifted the definition or thought of what an ETF is. As you said, there was a lot more popularity with the passive products as these low-cost beta vehicles, and I think that conversation and definition of really what an ETF is and the technology that's just behind it supporting these products has shifted as the active market has really grown.
Yeah, well, it lends itself a lot to the pairing, like how you actually run your book of business. We have a very large footprint in the separately managed account space. And so when we thought about ETFs and how that can work, whether ours or anyone else's, all of a sudden to have an active ETF that might be close to the SMA strategy, providing a liquidity sleeve if you're building up assets to invest in the SMA, or if you're in there and just have 5 to 10%, where if you have situations come up where you need liquidity, instead of selling the bonds or the individual securities, to have the ETF there, again, tracking to the same type of strategy, but as a liquid vehicle that you can trade, intraday if you need to. It just creates a lot of synergies that weren't there before.
Yes, certainly we're seeing obviously interest in ETFs, but SMAs as well. All of that is coming at the expense of mutual funds, and you can just see the data. It's it's pretty much as plain as you can see, and it's been about a $1 trillion plus swing the last couple of years of money coming out of mutual funds and into these other wrappers. So what's interesting though, I think, and it will be, I think, a bullish sign for ETF flows maybe going into the second half of the year, which is all that money that went into money market funds, which is a complete anomaly when you look at the data the last couple of years. There is a massive cash pile sitting there. We can debate if we're starting to see that leak more into the market and exactly where it's going. The data will tell us shortly. But I think, again, I'm pretty bullish that that money is going to come back into the market, and in every market cycle, ETFs have benefited. It's just only a matter of when and how much.
Yeah, we're having a lot of conversation about reinvestment risk. If people are sitting on their hands on cash on the sideline, interest rates might not stay at that elevated level forever. So at some point, you got to get back into the market and benefit if interest rates do go back down.
And of course, ETFs got a lot of press in the beginning of the year with the approval of the U.S. Bitcoin spot ETF. There was a lot of hype going into it. We finally got there. Matt, what would you say, what was the outcome of that?
Yeah, so Touchstone did not, we're not in the Bitcoin space. I think there's going to be a lot of fee pressure there, just because there are similar exposure across the different vehicles. and it's an area where I think brand and scale and price are going to be some determining factors there.
Yeah, it was definitely a very exciting, monumental, lead up, as you said, and day when the approvals came and then they ultimately launched. To Matt's point, there are several products that came into this space at this time. We'll see if there are others in the future, but I think it was just another great example of the resiliency and ability within the ETF wrapper for these new asset classes to trade right within the ETF structure. There were 126 million shares traded throughout the course of those 9 or 10 Bitcoin ETFs that were launched on that day. Really monumental flows that have gone into those products over the past 3 to 4 weeks. So we'll see if that I don't know if we call it a trend. Obviously, it was a very exciting day when those launches came. We'll see if future digital assets ETFs come to market in the future, whether it's Ethereum ETFs or otherwise. But again, obviously a huge step forward in bringing the digital assets kind of together with the equity markets.
And I think that's a great point that you make, because it really was the ETF wrapper that allowed this to happen, right? Individual investors, advisors, regulators, they understand how this wrapper works. And Ben, whether we're talking about other crypto assets going in the ETF wrapper, I think, think about it from alternatives in general. I mean, sky's the limit if you think about it in that respect.
Wait, Bitcoin ETFs were approved?
Yeah. Where were you in January?
That's right, I remember. So, look, we provide at BNY Mellon infrastructure to over 1.5 trillion of assets across the ETF industry. So we see a little bit of everything, including several of the Bitcoin ETFs where we provide that infrastructure. And it's really about, well, there's many things and there's many headlines here, but the most important thing, I think, it is an access product, and it's a way to provide access to advisors in a wrapper that they are comfortable with, familiar with, fit into their financial reporting infrastructure, and certainly ones that are easy to access. And we see this also happening in the alternative space as well. But the ETF wrapper is quite flexible, but it can only go so far. It doesn't make illiquid things liquid. Right. And there are certainly some boundaries there. And I think, honestly, we've seen an incredible amount of innovation. So I'm always kind of surprised at what a lot of the issuers will come up with. But I think, again, the products are working as advertised and really doing what they're supposed to be doing, which is giving the market a lot of comfort.
We've even seen filings already out there for spot Bitcoin ETFs with options embedded strategies as a component. So you want to talk about innovation on top of innovation?
Yeah, I think, for the reason ETFs have endured and thrived for 30 years is because people keep coming up with new ways, A, to use them in their portfolios, and B, how to stretch sort of the vehicle itself to take on new instruments. And I agree. Like I think however you think about digital currency sort of fitting or not fitting into a portfolio, it's the underlying technology that's actually really exciting. And when you think about sort of tokenization and what that could mean for the types of asset classes that could eventually be folded into vehicles like ETFs, when you can have atomic settlement on certain types of bonds that settle in 16 days today, when you can suddenly have access to real estate portfolios and take something that's highly illiquid and make it liquid, I think it's a real game changer for the asset management, the portfolios of the future. Yeah,
well, and speaking of that, because of the ETF wrapper allowing this innovation to continue and thrive, let's go back to mutual fund conversions to ETFs. Is this a trend that you expect to continue? And then also on a higher level, explain to the audience what the benefits are. Why would you want to convert your mutual fund to an ETF?
Sure. We did one earlier last year, I guess it is now. We're in 24. I think the conversions are definitely. I think we'll see more of them. I don't know that that's going to be the main thrust of how the ETFs or the active ETFs will grow, because there is a relative bar in that it's got to be good for the existing shareholders in the fund. So if you have a large allocation into retirement accounts that might not be able to handle a conversion from the fund to the ETF, that's not necessarily going to be a good outcome if suddenly the fund has a large drop in AUM. I think it's one of these things where it's a case-by-case situation, and if the idea is you're going to possibly increase tax efficiency for the strategy, if you're going to increase the distribution opportunities where you might be able to grow the fund and gain additional economies of scale, all of that is really positive, and those are some of the things that we think about. If you have sort of a lagging fund that's not doing well, converting it to the ETF is not going to be some panacea that suddenly it's going to move from there. So I think it has to be a very thoughtful strategy. I think that's what's happened to date and why we've seen assets that have converted across the board, a lot of the managers that have converted assets have then seen an uptake in the strategies.
I definitely agree. It's not a one-size-fits-all, right, to your point. And I'm just going to bring up SMA conversions as well. I don't know if those are always as highly, highlighted or reported on, but yeah, we definitely see SMA conversions, particularly maybe from RAs that are converting to ETFs for that tax efficiency and portfolio management efficiency. So I imagine that trend will continue as well.
That's a great point. We've done both for our clients, both the SMA and the mutual fund conversion, but Noel, the threshold is definitely high. It is not such an easy thing to do. It's a lot of work. There's some cost involved. So really, again, that threshold for the asset manager is high. And then on top of that, then making sure there's benefits to the shareholder. And it makes sense in addition to making sure that shareholder base is relatively convertible without too much disruption, and then making sure you communicate to your shareholders. All of these things, again, make the threshold high, so we're not seeing quite the avalanche, I think, that some expected, and but we will see more in 24.
Yeah, I completely agree with everything that's been said. I think it's a case-by-case basis. At Touchstone, we did our first one in December and listed with Nasdaq. It is a case-by-case basis. You mentioned the 401k assets, additional, if there's a lot of direct shareholders that would need to go out and set up brokerage account, that can be a hurdle too for those shareholders. But if it does make sense for the shareholder base, then giving them that strategy with the benefits of the ETF and the tax efficiency can make a lot of sense.
In fairness, there's also another big constituent here, which is the partner platforms that distribute the ETFs, right? So they've got a lot, that's not a costless exercise for them as far as coordinating, a conversion, and when you've got multiple sponsors all showing up wanting to do that. I think that's something the industry's been learning over time, as well as how to better coordinate with the platforms and work through that.
And there's been about 70 so far now. So I think there is a bit of a roadmap, both operationally with the service providers like BNY and also coordinating with the BD platforms to figure out what that looks like. So I think it'll continue, but at the same time, I think there'll be more new product launches relative to conversions.
Slow and steady.
Yeah, well, let's talk about 2024 outlook for a moment here. Matt, you would notice ETF as share class models. Tell us more about that and why you think that could be a trend for 2024.
Yeah, so that's something we're closely monitoring. That was under patent until last year. The benefits of it could be really unique because it offers basically a quicker path to scale. If you wanted to launch an ETF as a brand new product, it's got no track record, it's got no scale. If you can do it instead as part of an existing mutual fund that has potentially billions of dollars and it's been around a long time, that can benefit both shareholders. But it's to be determined whether the SEC actually approves it. There's 5 issuers that have filed so far, so we're continuing to monitor it closely, and if and when it gets approved, that could be a very interesting opportunity.
Noel, is this going to be a widely followed thing like the Bitcoin ETF? How long could this potentially take?
Well, I would think when you're dealing with sort of, share classes are not contemplated in the ETF rule or not permitted under the ETF rule, so this is, this would go through the exemptive application process to the SEC. I think, what we've been seeing the SEC do very logically is, as new things have come down the road, non-transparent active ETFs were an example. What happened with the Bitcoin filings? I think they've sort of seen, what's the interest across the industry? How do all the filings coalesce? And then try to get to some place that says we have a common set or a common approach where now everyone that's interested in this kind of comes to market at the same time. So I would expect we will see something similar with this approach with the SEC, which is good. It's a healthy clearing mechanism. Sometimes it can take maybe longer than everyone would like on both sides of the fence, because there's a lot of work for the SEC as well, but there's a lot of issues that have to get worked out. But I do agree a share class structure in the US would provide a lot of access to a lot of strategies that would normally take a while to build up. But it also, again, there's no free lunch. When you have a share class structure, everyone shares. So you might share in the tax efficiency, the mutual fund shareholders and the ETF share class holders. But if there's a capital gain distribution, everyone also shares in that. So I think you will always see some standalone ETFs, some conversions to ETFs, and if we have a share class permission at some point, some funds that just add a share class to go into that space.
There was even, sorry, Ben, there was even one issue where that really applied for the opposite, mutual fund share classes of an ETF. So, you could
to put into the 401k.
Exactly, yeah.
Yep.
So that's on the table as well.
Yeah, I agree with all the comments. I would just say I think it could be a game changer whenever it happens, and there's no doubt whenever the SEC approves, you're going to see many of these come to market.
This won't be 10 issuers showing up with a share class structure.
It's going to come to market fast. The one thing I would just also add, especially from a BNY Mellon perspective, look, we run a global book, and we're doing this right now outside the US. So the operating model works. The question is what type of disclosure, what exactly will the SEC allow, and some of the nuances here, but the bottom line is this has been working around the world for years, including with Vanguard as it is today.
All right, everyone, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me from the MarketSite studio. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.